as a junior accountant, we'd go out to these big companies, and a partner would give me a general ledger, like 5 accounts to test: repairs and maintenance, insurance, office, advertising, whatever. And then I'd circle the items that I wanted to check to see if they had supporting invoices, and they had approvals, they had shipping documents, what have you. In other words, there was backup to those expenses. The same for sales. You should have a shipping document, you should have a purchase order from the customer, you should have an invoice. So we would go into the source documents to support what's on the profit and loss statement or the balance sheet. That's what an audit was. It was kind of fun. We'd look at the AR, as I said before, and generally accepted accounting principles say set up a reserve percentage of sales or whatever. But we would really primarily look at the old stale stuff and say, you really got to write this off. You're never going to collect this. And so at a minimum, we would do that. And so it's kind of enlightening to a young accountant, because you have to know how to make journal entries and reclassifications. And you have to know how to talk to management and controllers, who probably had a whole lot more experience than I did at my junior level. And I was put in my place every now and then. And then what was really fun was when we would go out and count inventory. We had lumber yards, we had steel, we had like screw machine shops, we had sweater distributors and what have you. And, we would go out and count the quantities and of what they say they have in stock. And then we'd multiply those quantities by what they bought them for to figure out what our inventory was. Because as you know, whatever your inventory at the end of the year is an asset. And even though you bought it, you can't deduct it until you sell it. So the ending and the beginning inventories are very important. That's why we have to physically observe them. So that was all kind of fun. Okay, and then we end up with a working product with a minimum amount of disclosures, right? Of what generally accepted accounting principles we are employing to arrive at, what we consider to be a fairly stated financial statement. In other words, how quickly are we depreciating assets? Are we recognizing revenues when we bill them as opposed to when we collect them? Are we recognizing expenses when we incur them as opposed to when we pay for them? Are we accruing interest? What have you? Okay. And then the final exercise in an audit would be analytics. Let's compare this year to the last 3 or 4 years. Okay. And let's look where the spikes and the aberrations are. Let's look at your margins. You say you have a 30% gross margin, but this year you only had 20%. Why is that? Or this year you had 40%. Is your inventory too high? These things then we'll look at payroll. How come your payroll went up? Or how come payroll taxes is not roughly 8.5% of your payroll? Okay. And so there's all these interrelationships that in addition to all the substantive testing, all the what we call vouching, where we're actually going back to the source documents to prove or verify that you incurred this expense or you actually generated this revenue. Then we stand back and we look at it and say, does this make sense from last year to the industry and the relationships between the accounts? There should be some of that. And then back then the disclosures and the FASBs that were out at the time were probably so much more minimal than they are today. So we'd have disclosures on how we calculated income and expense and assets and liabilities.